Taxes, taxes, taxes. Every stock trader dreads tax season, which is why this class will be going over the basics of how taxes work in the world of stock trading. I'm Meta Matt, Director of Education at Penny Boys University, and welcome to class number 22 of Penny Boys University LITE. Make sure to check the description in this video for the handout. Remember, this is not financial advice, nor am I a tax advisor, so for legit tax help, go find one of those. Alright, so let's begin by discussing the different types of taxes that traders encounter in the stock market. Capital gains tax is the tax that traders pay on any profits they make from selling security. The tax rate varies depending on how long the trader held the security before selling it. Short-term capital gains tax are taxed at a higher rate than long-term capital gains tax. There's also dividend tax. If you receive dividends from stocks you own, those dividends are subject to tax. The tax rate varies depending on the type of dividends received. There are also trading fees, which are fees that traders pay to their brokerage firms that are not tax deductible. So it's important to factor these fees into your overall trading costs. So when it all comes down to it, how much is taken out? Well, if you buy 100 shares of XYZ stock for $10 per share and you sell them for $12 per share, your total profit is $200. If you held the shares for more than a year, you'd be subject to a long-term capital gains tax. And if you held them for less than a year, you'd be subject to short-term capital gains tax. The tax percentage is based on your income. The capital gains tax is typically calculated on a trade-by-trade basis rather than at the end of the tax year based on your overall performance. And like we said, you can also be taxed on your dividends and trading fees. So why are you taxed? Well, taxes are a necessary part of trading as they help fund government programs and services. Capital gains taxes are designed to encourage long-term investing, while dividend taxes help ensure that everyone pays their fair share of taxes on their investment income. Whether or not it's fair, there are ways traders can prepare for tax season with their trading plan. For one, you can keep accurate records of all your trades, including the purchase and sale dates, the purchase and sale prices, and any fees associated with the trades. You can also consult a tax professional to help you navigate the complex world of taxes and trading, which can help ensure that you're taking advantage of all the tax breaks available to you. And lastly, plan for taxes in your trading strategy. Consider the tax implications of your trading strategy when you're developing your plan. For example, if you know that you'll be subject to a short-term capital gains tax on a particular trade, and it's nearing a year of you holding that stock, and the stock seems like it's either in an uptrend or consolidating, you may want to hold off on selling until you've held the security for more than a year, so that you get long-term capital gains tax instead of the higher short-term capital gains tax. You can also plan to put aside a percentage of your profits to go towards taxes. In conclusion, taxes are an important consideration for traders in the stock market, and by understanding the different types of taxes and how they work, traders like us can better prepare for tax season and ensure that they're paying their fair share of taxes on their investment income, as opposed to more, of course. If you enjoyed this Penny Boys University LITE class, be sure to check out all of our courses in our Discord. I hope to see you there, but as always, until then, I hope that you all make some bread.